How's everybody doing? Today we're going to talk about how to choose the right moving average. This is what we're going to talk today. Not all moving average are created equals. Your trading style can be scalper, day traders, swing traders, long-term investor. So everybody have their own style. Your style can be scalper, can be day traders, or swing trader, or long-term investor. So today we're gonna find the best one, how to choose it. This is what we're gonna see today. So now, there is a moving average for every traders, but how do you find them? How do you find the one that fits you, the one that's best for you? So join us today. We're gonna dive on it. I'm gonna teach you step by step how to use the best moving average for your style. This is what we're gonna see today. So have you ever wondered why traders don't follow even when the moving average is moving, but they don't follow the right moving average? So the problem is that your strategy is because maybe you choose the wrong moving average. I'm going to teach you step by step how to use the right one today. So first thing, what is a moving average? A moving average, smooth price action. That's all they're doing. They smooth it. They smooth the price action. But choosing the right one makes or break your trade, because you got to know the right one, the best one that's good for you. There are different type of moving average, but you have to choose the best one. So that's the way, that's the what we're gonna see. We have two type of moving average. We have two type of moving average. We have what you call the simple moving average. We have the simple one, which is, we call it simple moving average, which is EMA. And we have what you call the exponential moving average. Exponential moving average. We have those two types of moving average. We have the simple moving average, and we have the exponential moving average. So the exponential, the SMA, which is the simple moving average, which is this one, the simple moving average, it take the average of closing price over a set period. Can be 50 days, can be 100 days, can be 200. So it's good for long term. Most of the time, people using the simple moving average for long term. You can use as a 50 days, like 50, or 100, or what you call the 200. The simple moving. The simple one used for the long term. Now, the exponential moving average give more weight. It gives you more weight to recent price. It react faster. So the exponential move fast. This is what you can see. That's the difference between the exponential and the simple moving average. The simple moving average, slow. They move slow. And you can use it for long term as a 50 moving average, 100, 150. So the exponential itself, it uses faster. You can use it for faster, like for day trade. If you do like 5 days, 1 day, 15 minutes, it goes faster. So it gives you more weight when you use the moving average, which is the exponential. Yeah, so that's the way you use them. I'm going to show you how to add them to your chart now. Now, common moving average used, we have, most people are using that. Those are the common moving average. We have what you call, we have the 9 moving average. Those are the common one. Those are the popular moving average. We have the 20 moving average. Those are the popular moving average. We call that popular moving average. Common one. Those are very popular. We have the 9, we have the 20, we have the 50 moving average. We can use, most of them use this for the long term. And we have the 200 moving average. Those are the common moving average. Those are very common. So you use those very fast. Most people use them all the time. So you see, the two types of moving average, as I told you, we have the SMA, which is a simple moving average, this SMA, and we have what's called the EMA, which is the exponential moving average. The SMA, which is very slow, this one is slow, very slow. And we have the exponential, which is fast. Yeah, this one is faster. So popular one are the 9 moving average, the 21, the 20 or 21, 50 and 200. So the 50 and the 200, we use it most of the time for long term. The 9 and the 20, you can use them for fast. So you use most of the time you use the 9 and the 20 for the when you use the EMA, which is the exponential moving average. And you use the 50 and the 20 for the SMA, which is the moving average, the simple moving average, which is going slowly. This one go very slow. Now, so the moving average, the 9 moving average, I'm going to show you how to add them. We have the 9 moving average, as I told you, the 9 and the 21 or the 20 moving average, which is very fast. This one is very fast. This one is very fast. And also, those are the exponential moving average, the EMA. So how you add it? So we're going to add the 9 and the 20 or the 21 for the EMA as expressed. So what you do, you go to your chart, you click on indicators, and you look for the exponential moving average. Where you see you have those are the two. This one, the moving average exponential, which is the one that's a faster one. You can use this one for you when you do what you call day trade. You trade for 1 hour, 15 minutes, 5 minutes. Those are the moving average exponential. You use the 9 and the 9 and the 20, and you use the moving average simple, which is the EMA, the simple moving average, which is the one that's set very slowly. This one are very slow. So you use this one, which is the SMA, use this one for real slow. Those are very slow. You can use as 50 and so we're gonna use first thing the moving average exponential, which is the faster one. So you use the 9 and the 20. So you, as you see, you go to indicators, you add there your exponential, you add it to time, and you're gonna put the 9. So you go there and you look for it, and you go on your setting there, and the 9, which is the 9 days of this, and then you can change the style. You can leave it as blue. Now, the moving average already been there as blue. Now, you go back to the second one, which is the 20 or the 21. You change the style. You put a different color so you can distinguish them, make a difference between them. You put your yellow and you put in the 21 days or 20 days. Most of the time I use the 20. Okay. The 20, you use the 20, and you click on OK. See, now you get those two moving average. Those two moving average there, as you can see there, these are the exponential moving average. These one are the exponential moving average. The exponential moving, don't forget, it reacts faster. That means it fast. You use these two because they been react fast. And when you use those two, which is the 9 and the 20 or the 9 or the 21, we call those two 9 moving average. The blue is 9 and the yellow is the 20. So they've been reacted very, very, very fast. But you use them most of the time for day trade. For day trade. Day trade. So you add them, you use them for day trade because what happened? They react fast. So you can use them for 4 hours, for 2 hours, for 1 hour, for 1 hour, and for 30 minutes, for 15 minutes when you trade because they react fast. So you use the 9 and the 20. Let me remove it. I'll just give you the difference today. Now, for the SMA, which is the simple moving average, the SMA is being react slow itself, very slow, because what happened is react slow. And you use this one for long term to look the chart for the long term. How you can get in for your long term when the stock go down, and you need to see the SMA for long term. So how you do that? So I'm just gonna first let me remove those moving average, remove everything. You're gonna use the SMA, which is the simple moving average. The simple moving average, remember, it reacted very slow. So what are they? As I've been told you in the beginning, you use the 50 moving average. You can use the 100, or you can use the 150. You can use the 200. But we're gonna add all of them. I'm gonna show you how you add them. Add them is the same thing. Let me just remove, clean my shot. You're gonna go back there. You're gonna go to indicators. By the way, we have a class that we offer. We teach you step by step how to use the moving, how to use TradingView. People that have TradingView don't know how to use it. We teach you a class step by step. It's only for $100. I teach you all those tools there, how to use all those tools, how to add your indicators, and how to use all those tools, your favorites. So take this class on my link. I put the link for you. It's only $100. And also, if you don't have the TradingView app, I think I put my link there also. It's gonna cost you, I think it's $19 to buy the TradingView. But with my link, it's gonna cost you less because we have what you call a 15 discount there. We put two links for you. The first one is for you to buy the TradingView with a 15% discount. It's gonna cost you very cheap because it's $14 or $19. With my link, it's gonna cost you cheaper. And secondly, we put the link for you to buy the class, how to use the TradingView, which is step by step how you're gonna know how to use TradingView. And also in this class, we put a second module for you where you can know how to use those candlesticks. It's only for $100. We will not find that nowhere. You're not gonna find this cheap class nowhere. Just click on it. Now, the simple moving average, we go there and we look for the simple moving average. We're gonna put the 100, the 50, and the 200. Now, we're just gonna put first. We're gonna add those two first. We're gonna add the 100 moving average and the 200 moving average. You go there, you click on simple moving average. We add it 2 times. Now we have the smooth moving average, the simple moving average has been added. So what you do again, don't worry, if you take this class, we will know how to add those and what to do. So with the trading, you click there, and you're gonna change the 9. It react for 1. So the 9 is for 9 days. When you see 9, that means 9 days. 100 means for 100 days. We're gonna add the 100. They react because it's slow for 100 days. That's the move smoothly. So you add 100, and we have the moving average there. So and when we go back there, you click on this. You're gonna choose this as a 200, and you're gonna choose it as a color red. You see, they are pushing themselves lower. You see, these are the moving average. Those are the 100 and the 200 back there, which is the red one. They react very slow. So therefore, that's the way you do when you do for long term. They've been for long term. So anytime, so how are you gonna make a difference between them? Anytime, because you know, as I've been told you, if you need to know more about moving average, we have a link there. We have the next video there. It's teach you step by step how to use moving average. So what it calls, so whenever you have the 100 moving, this one is a 100 SMA, this one is a 200. This is a 100. So therefore, the 100, what it does, let me just do this. Something there. Okay, so we have this one is a 100, and this one is a 200 moving average. So whenever you have the 100 moving average, which is the smaller number, stock is bullish. So that's the best time to buy for long term. You can buy it back there because the 100 is above the 200. It reacts smoothly, it reacts slowly. That's a simple moving average. If you add the 50 and the 100 or the 100 together, you can remove. For instance, I'm going to remove them again for you. I'm going to add the 50 and the 200 and the 150, because here we have the 100 and the 200. Now I'm going to add the 50 and the 100 or the 150. So I'm going to just remove this. I'm going to go back there again. I'm going to add them for you so you can have done some practice at both of them. And also I go back there and I just click on this and I'll add. This one is the blue. I will put this one as 50 moving average. Remember, the simple moving average, we use the 100, the 50, and the 200. Those are the long term. That's why we put bigger number. And we're gonna put simple moving average. It's already there, and we are there. So I'm gonna choose the next one, this one, and I'm gonna add this one as a 150 because we have 50. And I'm going to choose a different color. I'm going to put this one as a yellow. So as you can see there, now we have two moving averages. We have the 50 and the 150. Still, the 50 is above the 150. This one is the 50 moving average. This one is a 150 for long term. By there, because price is above. Those are we have for long term. And then if you add the 150 and 200, for instance, you're gonna remove the 150, you're gonna replace the 150, those two, because now we have the 50 and the 150. Now we're gonna add the 150 and the 200. So what I will do, I will remove them, remove everything. I will add them again. You see, I'll just give you some practice there. So that's the way you add your moving average. You click there, you add it 2 times, and then you close this one. Now you go back there, you're gonna look for this one, and you're gonna change it to 150 moving average. It's already been blue. You will leave it there. We remember this one is a 150, and the next one is 200. So I'm gonna go back there. I'm gonna change this to 200 moving average, and I will put color red so you can differentiate there. Yeah. So we got 2 moving average. You got which is the 150 there. That's a 150 moving average. And we have the 200 moving average. So they are very straight there. So the 150, which is the small number, or 150 days, stock is bullish because it's above the 200 moving average. Whenever a small number are above or is above the big number, stock is bullish. So you buy there because price is above. It's the same thing when you use the 9. Now we're gonna do again back to the exponential. This one was using for the simple moving average. Remember, simple moving average, we have very simple moving average. Simple moving average, we act very slow. And they are big number, 50, 150, 200. So we're gonna remove them. We're going back to the exponential moving average. Exponential moving average, remember that? Is we act exponential moving average has been react faster. Exponential moving average is react faster and is for day trade. If you do for day trade, it react faster. This goes very fast. And the simple moving average is slow. So what you're gonna add for the moving average, for the exponential moving average, we use the 9 and the 20. So we go there, we go again, you add in 2 times, and then we already got the 9 because one of them is 9. So what you go back there, you look for it, and you're gonna go and you're gonna change this style to 20. And we add a different color so we can differentiate them. So you don't confuse, we don't leave them the same color. And we have now the 9 moving average, which is the blue one, which is the 9 moving average for the blue, and this one is the 20. So now the stock is bullish. You buy there because the small number, which is the 9 moving average, is above the 20. Not only that, price as above those 2 moving average. So that's a bullish. But we do that for day trade. You can use it for day, for 4 hours, for 2 hours, for 1 hour, for 30 minutes, for 50 minutes. It depends your strategy when you trade. So my friend, it was a good pleasure. So what the best thing I'm going to give you a bonus. I'm going to give you the best setting combo that you can use. The best setting combo of moving average you can use, especially for day trade. I'm going to remove everything. You can use the best one you can use are the 9 and the 21 exponential moving average. Those are the 2 best. That's a bonus I'm going to give you. I give you a big bonus today. The big one, when you do day trade, for day trade, the combo of 2. When you do day trade for 2 combo, for those 2, you can use the 9 and the 21. So you go there, you look for simple moving average, which is not the simple. You use the moving exponential. You click on this to time. So you're gonna look for there again. We already got one, that's 9 moving average, and you look for the 21. So you go back and you look for the 21 moving average. You go stay, we choose to different 21, and you go there, you add 21. That's 21 days, meaning moving from 21 days in. So we have 2 moving average here. You got this one, which is the 21 moving average, and you have the blue one there, which is the 9. Those are the big bonus. By combining these 2 moving average, which is exponential moving average, which is the 9 and 21, you have a best big combo for day trade. Whether you use 15 minutes, use 5 minutes, the 9 and the 21 are the best combo. Anytime the 9 moving average, which is the small number, is above the 21, stock is bullish. Those are the big bonus, the combo you can use, the 9 and the 21. So if you like this video, just do me a favor, just subscribe, like, and share. It was Harry. And then anytime you subscribe and you share, you can have a chance to see the next big technical analysis. Don't forget to take the class. We teach you step by step how to use those style, which is the trading view, how to use all those tools back there, which is you step by step. If you need to know how to use them, take this class because we teach you how to use those tools. And also we teach you step by step how to use those moving average and the candlestick. And also click the link to get the 15% discount if you're going to purchase the Trading View app. So it was Harry. It was a pleasure to be with you. Thank you, my friend. Bye-bye. See you next time. We're going to keep in touch. We keep in touch. Take care. Bye-bye. See you next time.